Welcome to the Brennan Financial Services Market Review for the first quarter of 2017. I'm Deborah Brennan Tagg, and I thank you for joining us. Today we'll be talking about the global marketplace, which includes U.S. stocks, international stocks, emerging stocks, commodities, real estate, and fixed income. We'll talk about all of those topics, the headlines that affected those areas of the market, and also how they all come together in a diversified portfolio. Let's get started. Let's start with a high-level market summary. Under the top gray bar, you'll see the results for the first quarter of 2017. Now, most of us know that the U.S. stock market was up 5.74%. You see that with the first green arrow on the left-hand side. And we got a lot of attention this quarter with our market returns. But it's also impressive to see what the international developed stocks did and what emerging market stocks did. So the international developed stocks, and there you want to think about Europe, Japan, Canada, Australia, they were up 6.81% in one quarter. The emerging market stocks were up 11.44%. So overall, we had a great quarter in the U.S. equities, international equities, and emerging market equities. Just to give you a little comparison, if you look under the second gray bar, you'll see what the average quarterly return is for each one of those areas as well. And they surpass those extraordinarily in each one of those areas. Next, we'll look at global real estate. Now, global real estate was only up 1.44%, and the average there is 2.7%. So it did a little less than we had expected. If any of you remember from last year when we were talking about global real estate, we had great returns, and in many of the quarters it had surpassed what the equities had done. So we really have enjoyed seeing the global real estate in the portfolios, and this quarter was one where it didn't do as well as its equity counterparts. The real story now is on the far right-hand side under bonds, both the U.S. bond market and the global bond market. The U.S. bond market was only up 0.82%. And again, if we look under the second gray bar, we'll see that the average there is 1.2%. We've had a real shift in the bond market, and we'll talk about that a little bit further in the market summary. Now let's look at some of the headlines from the first quarter, which may or may not have affected the stock markets around the world. Obviously, we had a big event when Donald Trump was sworn in as president, and there's been a lot of discussion about the Trump rally that we've had, especially in the Dow. The Dow closed over 20,000 for the first time this quarter, and that was pretty impressive in and of itself. But there are some other things that we need to look at as well. We see that China's exports rebounded sharply as global demand is growing. That's really, really important. We've had very slow global demand for a long period of time now, and if we see global demand start to pick up, that'll be good for countries around the world. Alternatively, we see that world trade flows grew at the slowest pace since the financial crisis. That's obviously not good news, and so it means that we need to watch carefully about what's going on as global demand is picking up, but world trade flows are slowing down. We also saw that the U.S. jobless claims were the lowest since March of 1973, and we see that the U.S. consumer confidence reached the highest levels since 2000. Those are both very, very positive signs, and part of what's going on right now is that there's been a shift in sentiment now that the Republicans and Trump are in Washington, and they have a change of tone about policies that will be directing the country and the economy for at least the next 4 years. Now we'll take a look at the headlines from the past 12 months, again to give us some context about what we're seeing in the markets. So as you may remember, the beginning of 2016 was pretty ugly in the stock markets. We saw a big drop-off. We saw some really ugly returns for a short period of time. There was even some discussion about whether or not we were going into a severe bear market in something that looked like 2008. At the time, we had a lot of weak indicators from the economy. We had oil that had dropped off significantly. There was a lot of uncertainty around the oil market, and things just felt like they were not going in a positive direction. Now, we did see the rebound happen at the end of the first quarter, so it was a very short-lived downturn in the equity markets, but it certainly gave people pause and gave them some time to think about, are we going in the right direction? Are we going to be able to get back on a growth pattern? You can see from some of the headlines that we really had lots of lackluster data and headlines throughout the entire year of 2016 leading up to the election. So we saw that there was weak hiring, China's export decline was accelerating. The world trade was set for the slowest yearly growth since the global financial crisis. The global inflation had fallen to a 7-year low. Those are all very, very ugly signs for the global marketplace. And what it seemed like is that there was just a big wet blanket over any growth anywhere on the globe. Then immediately after that, in November, we saw that Trump won and the Republicans came in, and there has been a huge shift in tone since then. So why is that? It's a couple of things. Trumponomics, as it's being called, involves a couple of things that are key to getting our U.S. economy back on track. So he's talking about lowering the corporate taxes, which could have a massive effect on the economy and the future of the stock market. He wants to lower the taxes on the top 1% of taxpayers. And that has a lot of debate around it, but the reason that he wants to do that, or one of the reasons that he wants to do that, is because it will help small business owners, since many small business owners fall in the top 1% of taxpayers. So they are trying to do that to spur small business activity. They also want to do a huge infrastructure spend and create lots of jobs. And then they want to reduce regulations across all industries. And all of those things can be put in a bucket of growth for the U.S. economy. So there's a lot of positive momentum, even though much of this is yet to be decided. We've already seen with Trump and the Republicans not being able to get health care through at the time and in the way that they anticipated doing it. That does cause the market, and certainly those who are watching the economy, to wonder how quickly all of these things will come to fruition. If they can pull off everything they're talking about, it could create a huge economic growth cycle for the U.S. economy. But again, the proof is in the pudding, and we'll have to see if they're able to do that. In the meantime, the Fed has had a completely different change in tone. So at the end of the year last year, they raised rates again, and the first quarter of this year, they raised rates again. They haven't done that in years. And so we had the first increase in interest rates at the end of 2015. The second one at the end of 2016, and then again in 2017. They had just trickled a couple of rate increases on us, and now they're saying that we're going to see 2 or 3 increases in interest rates in 2017. Now, some people might say, will that be bad for the bond market? They might say, will that be bad for the real estate market? This is pretty well baked into the economy. It's pretty well baked into the markets right now. So if the Fed stays on the same path that they're on, that they've been very, very clear that they're going to be on, it will be a challenge for those markets, but it's not something where we need to consider that that's going to have an extremely negative effect on either the bond or the real estate market. If they surprise the markets, or if they get much more aggressive about raising the interest rates, we will need to take a different point of view on both the bond market and the real estate market, as well as some other areas of the market that can be affected by the Fed raising their interest rates. Okay, now let's look at world asset classes and how they performed in the first quarter of 2017. So we've mentioned the emerging markets and how well they did. The top bar there is the MSCI Emerging Markets Small Cap Index, and it returned 13.02% in one quarter. Now, by all accounts, this is going to be a very risky and volatile index. Nonetheless, it had great performance, at least for this quarter. If we drill all the way down to the bottom of that slide, we'll see the Dow Jones U.S. Select REIT Index that actually lost money in the first quarter. Now, U.S. REITs have enjoyed a strong 5-year performance run, but this is very common for us to see that parts of the market would actually flip-flop from quarter to quarter and from year to year. This is one of the reasons that we want to have very deeply diversified portfolios, so that as one part of the market does a lot of performance for us, there might be another part that falls off, and then the following quarter, the part that fell off is going to be a great buying opportunity. Now, all of these are just indexes. None of these are pure investments, so I do want you to be aware of that, but it's great for us to be able to see that we have parts of the market that can do extremely well, parts of the market that may be not as strong, and as we trace this from quarter to quarter, we will see them shift positions. Turning our attention to the U.S. stocks for the first quarter of 2017, we'll look on the top right-hand corner of the slide and see that even in U.S. stocks, we saw wide variation in returns, from large cap growth making 8.91% and small value with a negative return of 0.13%. You see that market-wide, which is the third bar down, had a return of 5.74%. So that's the return for the broad market. And we hear some people saying, gosh, I wish I had jumped in for the upturn of the market. I wish I had experienced this. I guess it's too late to do it. What we do see is that there are still great opportunities. Large cap value is only up 3.27% for the quarter. And again, if you're looking for an opportunity in U.S. equities, small cap value might be an area to explore. All of these different areas are going to have different growth potential over the next year, 2 years, 5 years, and 10 years. And speaking of 10 years, let's look at some 10-year numbers. So let's look at the bottom right-hand corner of the slide. You see that under the 10-year returns, which I will remind you includes 2008 and the financial crisis, we see that the market-wide return for the last 10 years has been 7.54%. That's for an investor that remained fully invested from 2007 all the way through 2017. Large cap returns 7.58%, large cap value 5.93%. All of these healthy and positive returns. If we look under the 1-year column, we see some pretty phenomenal numbers. So we see that market-wide, the return has been 18.07% over the last year. And again, that is for a pure U.S. equity portfolio. And also we need to focus on the fact that a year ago, in the first quarter of 2016, we had that big downturn in the market. So we're measuring this from a very low point in the market to a very high point in the market. All right, next up is a look at international developed stocks for the first quarter of 2017. Again, we'll start in the upper right-hand corner, and we see some pretty impressive returns for one quarter. Some of those numbers are even what we would assume we might see over a year's time. But let's now look at the bottom right-hand corner and look at the returns for international developed stocks over 1, 3, 5, and 10 years. Over 1 year, the returns, again, like the U.S. stock market, have been impressive. The numbers are not quite as high as the U.S. stock market, but nonetheless impressive and would add return to a portfolio. But look at the 3-year numbers. The 3-year numbers are very close to flat and even negative for value. So that actually was a drain on performance for any globally allocated portfolios. And a globally allocated portfolio would include not just U.S. stocks and bonds, but also international. And the 10-year numbers are very similar. That is striking, especially when we think about what we saw on the previous slide about the returns for the U.S. stock market. The 5-year numbers for international developed are fairly healthy, but those 3 and 10-year numbers would still be a drain on globally allocated portfolios. The emerging market stocks have a very similar story to the international developed stocks. Starting in the upper right-hand corner, we see impressive returns for the quarter, but if we look just below that, we'll see that the longer-term returns have really not been a contributor to portfolios. We see high growth over the past year, numbers like 17 and 14%, but the 3, 5, and 10-year columns are really telling. We see even returns that are negative over a 3 and 5-year period. So emerging market investors have the possibility for high growth, but they also have to expect lots and lots of volatility. This slide highlights what some of these countries have done both in the developed markets and in the emerging markets. A couple of stories we'll be watching this year are the United Kingdom as they walk through the Brexit process, and also India. India had huge returns in the first quarter, but there is lots of concern about whether they can sustain the kind of growth that they're having right now because of the infrastructure needs that they'll have over there. But when we say how on earth did the international developed and emerging markets indexes do so well, we can look at how each one of these countries performed, and it's very obvious how we got those numbers for the quarter. Here we take a look at how other countries' currencies performed against the US dollar in the first quarter of 2017. Now, the dollar has had substantial strength for quite some time now, especially since Trump came into office, and so losing some of its value is actually fine. What the slide is telling us is that many other countries' currencies appreciated against our dollar, and what happens when our dollar gets too strong is that other countries don't want to buy our goods anymore, and so our exports actually fall off. So it is good for our economy if the dollar has a good balance and is on par with other currencies around the world. We actually don't want it to get so strong that it reduces our export level. So what we're seeing here is nothing to be concerned about. As we discussed earlier, real estate did not perform as well as its stock market counterparts. So for the first quarter, US REITs actually lost a little bit of money and global REITs had a performance of 3.62%. I do want to take a look, though, on the bottom right-hand corner at the 3 and 5-year numbers. So US REITs over 3 years have had a performance of 9.96% and a 5-year performance of 9.45%. The 10-year performance, again, including 2008, has a performance of 4.22%, and that was the worst real estate crisis that our country has ever seen. Real estate investors should be long-term, and what we see here is that even though we have a 1-year performance of 1.21%, those longer-term numbers have been very positive and beneficial for investors. Commodities have had a rough ride for the last 10 years, but finally, over the last year, the investors were paid off. So if you look at the period returns on the bottom left-hand corner, you see that the 10-year numbers are negative 6.22%. For 10 years of investing, they still lost money. 5 years down 9.5%. 3 years down almost 14%. But over the last year, commodities investors did gain some of that back with a return of 8.71%. We don't invest in commodities directly, but we do pay attention to them. And on the right-hand side, there are a couple of things I want to point out. The third one down is gold, and our clients love to talk to us about gold. It had a return of 8% in the first quarter. Gold is more of a fear and greed asset than it is a supply and demand asset, and so it tends to make money when there's fear in the marketplace, and the returns tend to fall off when there is assurance and confidence in the marketplace. So it'll be really interesting to watch gold over the next 24 months. Also towards the bottom, because we're in Texas, we have to point out West Texas crude oil, which had a performance of negative 9% in the first quarter. And it'll also be interesting to see where crude oil goes this year. The big story for 2017 is fixed income, or the U.S. bond market. The Fed has been very clear that it is time to get back to a normalized interest rate policy, and we are still far from a normalized interest rate policy. So they did raise the interest rates in December and again this quarter, and we expect to see a few more interest rates, either 2 or 3 this year. Now, they did say the same thing for 2016, and they only increased the rates 1 time, but there's a greater expectation in the market this year that they will increase at least 2 more times, maybe 3. While the Fed has been very clear about its policies, the 1-year return numbers in bonds show us that not all bonds are created equal. Let's take a look at the top line, which is the U.S. government bond index, which is very interest rate sensitive. Over the last year, U.S. government bonds lost almost 5%. If we look 3 lines down and look at the U.S. corporate high yield index, the positive return there is 16%. It's up 16.39%. That is a spread of about 20% in return. It is very important for bond investors to understand that there are varying levels of growth potential, of income potential, and of risk or loss potential in bonds. The high yield bonds move more in lockstep with the stock market, so they are not considered a way to reduce volatility or risk in a portfolio. U.S. government bonds are more focused in that area and are generally seen as a way to reduce volatility in a portfolio. However, if we believe that they're going to have huge headwinds and will either have flat or negative performance, they may not belong in portfolios at such a high degree going forward. We've talked about stocks around the world, real estate, and bonds. Now let's take a look at how all of these play together. What we're looking at here is the diversification of different portfolios from 100% stocks to 100% treasury bills. In general, a portfolio that's 100% stocks is seen as being much more risky than a portfolio that is 100% in treasury bills. If we look on the bottom right-hand corner, it's probably the easiest way for us to see what these different markets have done over time. So this takes us all the way back to 1988. And if you look at this chart, which is called a mountain chart, the top line on the mountain chart is going to be 100% stocks, even in the parts of the market where we had severe downturns in the beginning of the 2000s, and then obviously are into 2008 and 2009. Now, in a period like we're in right now, where U.S. stocks have done significantly better, or a portfolio that's 100% stocks has done significantly better than a portfolio that is 100% bonds, it's easy for investors to get more bold, feel like they can take on more risk, but the true test of how much risk an investor can take on is when we get into the period of 2008. The reason that investors, or most investors, are not invested 100% in stocks, even though it's the top performer during the entire period of the mountain chart, is because they can't stand to be in the stock market in periods of 2001 or periods around 2008. And so we need to make sure that investors stay invested over the long term, which is why we bring in a variety of different asset classes, and that will change the risk dynamic of the portfolio and also changes the return potential of the portfolio. On the bottom left-hand side, you'll see that this plays out under the period returns. Again, the portfolio that's 100% stock in all time periods, 1, 3, 5, and 10 years, is the top performer. But that pesky little column on the right-hand side is about standard deviation. You don't need to know a whole lot about standard deviation other than to know that on the 100% stock portfolio, it's 17, and under the Treasury bills, it's 0.36. What that means is that the stock portfolio can move around in value a whole lot more than a Treasury bill portfolio is going to move around in value. And so investors have to understand, can I tolerate that risk? Can I handle that much loss in value during a time period in order for it to pay off for me over the longer time period? So it's a short time period versus a long time period decision. And that's where it's very important for investors to have an understanding, especially in a market like this, which has had great returns over the last year. Are they in the right place? Are they in a place that they can stay invested in even when the market takes an inevitable downturn like it does every few months or every few years? It's very important for clients to be able to understand, and for all investors to be able to understand what the risk is and then what the return is that's possible for them in the portfolio that they're in. Thank you for joining us today. This market summary is designed to help you to understand the world of investing and to be confident in your investments. Feel free to share it with others. If you have any questions for us or any suggestions about how we can improve it, please email us at teamdbt@brennanfinancialservices.com.